Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
The federal government loans American International Group, AIG, $85 billion.
This is a different kind of market, and the Fed is asleep.
The federal government is stepping in to stabilize Fannie Mae and Freddie Mac, the two mortgage giants that have been threatened by the housing crisis.
The Bank of England has pumped £75 billion more into Britain's ailing economy with a new round of quantitative easing.
You print a couple $1 trillion, and all of a sudden people start to worry. So out of this worry, we have something called the Bitcoin.
Welcome to On the Brink. I'm Matt Walsh.
And I'm Nick Carter.
And this episode is brought to you by Withum. Withum is a top 25 accounting firm. They have a cutting-edge digital currency and blockchain technology practice. Wherever your company is, from a stage perspective, from pre-seed to IPO, they have tailored solutions just for you. They have helped some of the largest companies in the crypto industry with audit, tax, and advisory needs, and they've also helped a number of our portfolio companies. To learn more about advisory, audit, and tax services, head over to onthebrink.link/Withum. That's onthebrink.link/Withum. Withum, they know their accounting over there.
We love accounting on this podcast. We're the number one crypto accounting podcast that's not specifically about accounting.
If you're in this industry and you have an accountant that doesn't know about crypto, you're just in a world of hurt. So that's why you got to go to Withum.
Exactly. So this week was can we call it the regulatory season?
Yeah,
reg season.
I took out the FUD dice, and I don't see Gary Gensler just taking down DeFi on the FUD dice.
We actually didn't have a panel for what's happening, so maybe that makes it true FUD. Like good FUD. We
have a lot to get into this week. We were down in New York this week. We had a nice little gathering. It was fun to see people in the flesh. And then on the way back, we saw someone destroy a truck on the Merritt Parkway. That was
God. Yeah, so there was a debate on Twitter because Alex Thorne over Galaxy doesn't like Merritt Parkway. But Teddy Fasaro, on the other hand, likes Merritt Parkway.
Teddy's he likes everything in Connecticut, but the Merritt, if you're a truck driver and you're on the Merritt, you're on the wrong road. And we saw that. Right. We saw a truck hit the bridge and just eviscerate the truck, basically.
So it skimmed off the top of the truck, like completely. It was like a can being opened or something. You know, when I drove to Boston, when I moved here, I drove a moving van that was 9 feet 1 inch tall. And I didn't get the guidance about the Merritt Parkway. And so I had 1 inch of clearance on some of those bridges. Because the lowest one is 9 feet 2 inches.
That's no way to go through life. That's tough.
It was extremely stressful. I actually ducked as I went under some of them.
Yeah, you got to take 95.
But so we saw a truck, right there. We saw a truck get completely scalped, basically.
It was almost like a synthetic DeFi asset in 2 weeks when the SEC gets around to just taking them down.
That's intense. The truck driver, he looked pretty chastened, but from what I've heard, this actually happens all the time on the Merritt. So opinions are divided on the Merritt, but I think it's a very picturesque and a nice road.
I'm out on the Merritt. I'm out on it.
You're not?
No,
okay.
I'm out on it.
That's fair. I'm still Merritt pilled. But yes, it is definitely a tough week for the regulatory side of the equation from a number of perspectives. I guess we can talk about that. We also produced some content this week.
A lot of content. So you spoke at the ARK Invest and Square, the B Word conference, I guess. The ARK Invest and Square hosted that conference, which I guess you pre-taped it, but you did a nice talk on debunking the Bitcoin waste energy argument. And some people were calling you, Bitcoin Carl Sagan.
Was that CMS Holdings that said that?
Yes.
I don't really know who Carl Sagan is.
So I think it was a compliment. It was a compliment.
Okay. I'll certainly take it. It was a good conference. I think the ARK team and the Square team deserve plaudits for putting it on. I don't like the name because I consider it vulgar by implication. I think it implies vulgarity. But beyond that, I thought it was a really good conference. And Elon admitted that SpaceX owns Bitcoin. That was a new thing. Yeah,
that didn't really get a lot of play, but that was interesting that SpaceX.
That was confirmed. Bitcoin. Yeah, that was not public knowledge before. The the Elon portfolio, so he obviously owns equity in Tesla, SpaceX, and I guess his other companies. It's the most Zoomer portfolio conceivable. Then he personally owns Bitcoin, ETH, and Doge. And so that's his whole portfolio. He said he doesn't own any stocks.
Bitcoin, I don't think is really going to work from a consensus level on some of these SpaceX rockets as they go to other planets in the next 20, 30 years. The 10-minute block time is going to be a problem.
That's correct. Bitcoin mining could not really achieve stable consensus between Earth and Mars. That math has been done. I think it was Drew over at Unchained that wrote a good blog post about that a while back.
Just put that as another reason not to buy Bitcoin. It won't work on Mars, so what's the point?
I mean, it would work. It's just that you couldn't really mine profitably on Mars if the center of hash was on Earth. So you'd still be able to receive blocks and, run a full node for sure. You just wouldn't be able to mine.
I think it just means the brokerage opportunity, the centralized brokerage opportunity on Mars is enormous. It's not completely untapped.
That's a very good point. I don't know what regulatory... The SEC probably has claimed jurisdiction over Mars already at this point. The New York Fed, I'm sure.
There's going to be
money transmitters.
There'll be a speech before the American Bar Association exerting influence and jurisdiction on that Mars planet.
The long arm of the American securities regulator. So that was a good conference. I thought Elon was like sounding a little more mature, perhaps, than some of his prior statements. Kathy Wood impressed me, as she always does. And Jack Dorsey was great.
Yeah, it was a terrific conference. You also wrote a piece this week for CoinDesk. So there's a paper that came out. I guess we can talk about this now. So Jeffrey Zhang, who's an attorney at the Federal Reserve, and Gary Gorton, I guess is the way you pronounce his name. He's a professor at Yale, wrote a paper called Taming Wildcat Stablecoins. And it took kind of a negative view on stablecoins, and it compared them to the 19th century United States, what they called the free banking era, kind of the pre-Civil War era where there was no federal currency in the United States. And you took some issue with this.
Yeah, listeners of the pod, the Brink Nation, the Brinkers, already know the problem with what they're saying in this paper because they've heard us talk about it on this exact show before. The antebellum laissez-faire banking period in America was not true free banking. We've discussed this before on this show.
It was not true free banking, and I guess these guys ignored the, other periods of time where there actually was free banking.
The successful historical epics of free banking in the 18th and 19th centuries in Scotland, very successful, in Canada, in Sweden, in Switzerland. They're ignoring the successful laissez-faire banking episodes that are well documented in history. And they're focusing on the partially regulated, not true free banking instance that happened in the 1830s to 1860s in America. Come on, talk about being a little myopic and, a little parochial. Look abroad. There's plenty of examples.
The model has worked elsewhere for sure. George Selgin jumped on that on Twitter and issued some clarifying comments.
We may or may not be recording with George Selgin next week. That's me rubbing my hands. I don't know if you can hear that. I'm very excited. George, of course, one of my Bitcoin heroes, even though we forgive him. He doesn't really like Bitcoin. He's still very important in the history of Bitcoin. Infamously being cited by Hal Finney. But yes, George made his whole career out of making the point that state governance and regulation over the banking sector is not strictly necessary for the banking sector to deliver a high quality of service, basically. And the Scottish example is one that him and Larry White talk about. We had Larry White on a while back because the Scottish example ran from 1716, I believe, to 1844 with incredible stability, virtually no state oversight. The notes traded at par, but they were mutually accepted among different banks. There were no bank runs. There were basically no financial crises. There was moderate deflation. They delivered a high level of service effectively, and bank failures were extremely few. And when they did occur, depositors were actually made whole because the banks were unlimited liability, not limited liability. So the shareholders in the banks got their fortunes kind of clawed back to make the depositors in the bank whole. That's just one example. So anyway, there is a robust literature covering other genuine free banking episodes, the so-called Wildcat banking, which kind of refers to bank failures in Michigan in the 1830s, I believe. Like the banks were not free. They couldn't engage in branching, which means they couldn't expand nationwide. And so they couldn't diversify their sort of depositor base. So they'd get really concentrated portfolios of people that all had the same, specific types of needs and, behaviors. They were forced to hold state bonds in many cases. So the states forced them to hold state bonds, which were really not an instrument you wanted to hold. When the Civil War started, a bunch of the states defaulted basically on their debt. And so the banks that were forced to hold these bonds went under. And so the failure of the banks wasn't, because free banking, it wasn't due to an absence of regulation. It was due to the presence of regulation. Anyway, Gordon and Zhang know this. They obviously know this. Like, if you're a student of history, if you're an economist, you've read a bit of monetary history, you know this. These are just historical facts in the historical record. So they're being very selective in ignoring the record to make a point against stablecoins, which is unfortunate.
Yeah, well, we're glad that you're out there patrolling for these injustices.
I just can't believe that this became a thing. Like, this was one of my weird niche topics. Like, yes, we never had real free banking in America, but then somehow this became a really important part of the contemporary discourse around stablecoins and CBDCs. How's that even possible?
Yeah, it's it's definitely, now it's getting Krugman and all of the mainstream economists are getting on it now.
I liked it better when it was niche. I liked it better when the free banking wasn't being misrepresented. Anyway, there's a good resource I'm going to link in the show notes by Gerald Dwyer. Piece entitled "What Do Wildcat Banks Tell Us About Stablecoins?" Very good additional context. But yeah, read Selgin, read White. There's a good literature out there. Just consult the literature.
And then you made Alphaville today. So Financial Times had an analysis of your paper that you wrote with Linda Zhang from Georgetown, the DeFi protocol risks paper. So that was nice to see you in the FT.
Yeah, I was really happy with that, especially because it's Isabella Kaminska, who I've always respected as a writer, even though she has been a long time strident critic of Bitcoin. But she completely changed her tune recently, and she's much, much more amenable to Bitcoin these days. And she was nice enough to write kind of a brief little review of my paper with Linda, which is on basically a paradox in DeFi. Now, what the paradox is, you're going to have to read the paper to find out.
So definitely check that out. Well, why don't we get into some deals? There was a enormous deal this week. So FTX, which is the Antigua-based cryptocurrency exchange, they raised $900 million at an $18 billion valuation. I believe that's the largest Series B in the crypto industry of all time. The round included Paradigm, Ribbit, Sequoia, Insight, Third Point, Thoma Bravo, SoftBank, Lightspeed, Altimeter. The list goes on and on. So it's just a star-studded investor group here at a really attractive valuation from an FTX perspective. So congrats to the FTX team.
Is that the largest private raise for a crypto exchange ever?
I think so. I think it is.
What was the total amount of the Coinbase IPO raise?
Well, Coinbase didn't go public via IPO. They went public via direct listing, and then they raised a convertible note afterwards.
Yeah, so not really directly analogous, but yeah, I believe the largest single private exchange raise ever. Congrats to them. OpenSea, speaking of monster raises, we got a few this week. OpenSea, of course, platform for selling NFTs. There is $100 million in a round led by Andreessen, with participation from Coatue, Mike Olovitz, and others.
Next one up is Terraform Labs. This is a South Korean company. They're behind the Terra blockchain. They raised $150 million for an ecosystem fund, and that was from Arrington XRP, Pantera, Galaxy, and Block Tower.
Then we have a SPAC announcement. So Core Scientific, which is a Bitcoin mining hosting company, merging up with Blockcap, which is the biggest miner in America, Bitcoin miner. They're going public via SPAC. That combined entity, SPAC merger with Power and Digital Infrastructure Acquisition Corp, valuing the new entity at $4.3 billion. That would be the largest publicly traded miner in the U.S. Congrats to Darren Feinstein. Congrats to the team at CoreSci and Blockcap. They're totally under the radar. There's a very interesting story behind where all their mining occurs. Absolutely fascinating story.
Are you going to tell it?
I guess if you want to hear it. So back in the day, founder Darren scouted out all of these locations for energy in the U.S. and looked for the best hosting opportunities and found in the Appalachians these neglected energy resources that have been built to support the Manhattan Project, of all things. A lot of it was hydro down in the Appalachians. And they'd been kind of furloughed, or they'd had some other industrial uses and sort of fallen into disrepair. And so he actually moved into a cabin in the Appalachians and just built up these facilities back again and turned them into the biggest Bitcoin mining resource in the U.S. So a direct line of continuity from the Manhattan Project to present-day Bitcoin mining.
That was a cool story. That did not disappoint.
Yeah, I think it's cool too. And Core Sci, they do disclosures. They're classic kind of modern Bitcoin miner, contrast with the largely anonymous miners out in China. Core Sci does disclosures about their energy mix. They're part of the Bitcoin Mining Council, and they buy carbon offsets. So, eat your heart out, Elon, is what I'm saying.
But congrats to the CoreSci team. Next one up is Virtual Human Studio. That is VHS for short. The company behind the popular horse racing application Zedrun. This Zedrun thing is very popular. Basically a kind of a gambling style game built with NFTs. They raised $20 million in a Series A round led by Chernin Group with Andreessen Horowitz and Redbeard Ventures.
Next up, we have Vincent, a search engine for investments in alternative assets. They raised $6 million from Jason Calcanis and DCG.
Next one up is Thesis. This is a crypto venture studio. They raised $21 million in a Series A round from Parify, Nascent, Fenbushi, and Polychain.
Thesis, the original home, or that's at least where Keep originated from, and Fold.
Correct. That is correct.
Then we have Magic, a decentralized identity startup formerly known as Fortmatic. They raised $21 million, $27 million in a Series A from Tiger Global and North Zone.
Next one is Titan. This is an investment management platform. They don't have a crypto product out yet, but they intend to release one, and they raised $58 million in a Series B round from Andreessen Horowitz, General Catalyst, Box Group, and others.
So those are the deals. There are a lot of deals happening, despite some, dare I say, regulatory headwinds. So what's going on? What did Gensler deliver us this week?
All right. So I think this is the news of the week, and I don't know, it's gotten coverage. I don't know if it's gotten appropriate coverage, because I do think that this will have major ramifications here. So there was a speech by SEC Commissioner Gary Gensler. It was on Wednesday. It was before the American Bar Association Derivatives and Futures Law Committee. That rolls right off the tongue. And the portion of the speech that I kind of took note of here, and that I think a lot of people in the industry did take note of, is the following 4 paragraphs. So I'm going to quote here. Before I conclude, I'd like to briefly discuss the intersection of security-based swaps and financial technology, including with respect to crypto assets. There are initiatives by a number of platforms to offer crypto tokens or other products that are priced off of the value of securities and operate like derivatives. Make no mistake, it doesn't matter whether it's a stock token, a stable value token backed by securities, or any other virtual product that provides synthetic exposure to underlying securities. These platforms, whether in the decentralized or centralized finance space, are implicated by the securities laws and must work within our securities regime. If these products are security-based swaps, the other rules I've mentioned earlier, such as the trade reporting rules, will apply to them. Then any offer or sale to retail participants must be registered under the Securities Act of 1933 and affected on a national securities exchange. We've brought some cases involving retail offerings of security-based swaps. Unfortunately, there may be more. So to kind of tease that out here, I think it's very interesting that he calls out stock tokens, stable value tokens backed by securities, and synthetic securities. And so my quick framing of this is, let's look at centralized stablecoins and decentralized stablecoins. And there's a possibility here to interpret that some of these things may be securities. And before I kind of get your thoughts on this, what comes to mind immediately is the centralized stablecoins that have underlying collateral that is commercial paper. So these things are securities, this commercial paper. And so I wonder if the SEC is taking a look at these things and saying, look, it's backed by things that are securities, does that make them securities? So thinking about Tether or think about USDC to a much lesser extent. The other thing that this brings to mind is platforms like MakerDAO, which are decentralized, and he specifically calls out decentralized finance. These are collateralized by things that could also be deemed to be securities and could also bring them into the crosshairs. So what do you make of this?
It's hard to know. The most expansive reading of what Gensler is saying here indicts so many of these structures in the crypto space. I am inclined to read it more charitably, perhaps, but it would be odd to me if fiat convertible stablecoins were considered to be securities. I know there's an act entitled Stablecoins Are Securities Act, which was floating around a couple of years back, but it seems to straightforwardly fail the prong of Howey, which is expectation of profit, right? Like, there's no return from holding a stablecoin. Stablecoins don't typically even pass interest along to holders, which they could do, but they don't do. So if you hold a stablecoin for any period of time, you're looking at a guaranteed loss effectively, unless the underlying sovereign currency rallies somehow. So I just don't see it as satisfying that prong of Howey, regardless of interpretation. I totally dispute that.
It's what do you make of the decentralized finance implications here? So specifically, there's a call out here around assets that provide synthetic exposure to underlying securities. There's obviously a lot of assets in DeFi that fall under that umbrella.
Yeah, I mean, it's like, obviously he could be making indirect reference to a maker or synthetics. I mean, no question, there's a lot of DeFi products which fall under that definition. The question for me is he seeking clarity around having these teams disclose, or I guess, like, what's Gensler sort of proposing here? Is he proposing that these kind of like derivative products trade only on regulated exchanges or like ATS venues? Is he proposing that DAI, which is the output of the maker system, somehow become enmeshed in the disclosure-based securities regulation regime? It's really unclear what the actual suggestion or output of this is. So it's kind of still quite opaque to me, I'd say.
It's also going to be interesting just to see how this unfolds with you when you look at the centralized stablecoin operators here. So Paxos, so Dan Burstein, who's the general counsel and chief compliance officer of Paxos, same day, a couple hours later, wrote this blog post basically comparing the Pax token to Tether and USDC, calling out the fact that USDC in his mind is not regulated. And so now we kind of have this like mudslinging going on within the issuers of centralized stable coins that, frankly, like probably doesn't help that much if you're hoping for a good outcome here. So that'll be interesting.
Well, I mean, they regulated under the money transmitter kind of approach, and they are regulated by FinCEN as a money service business. So these stable coins are regulated, perhaps not in the way that some would think is the most prudent, but there's certainly regulatory oversight. Now, are states best equipped to provide real oversight over stable coins in terms of them potentially custodying a large asset portfolio and, trying to match the maturity and liquidity of that asset portfolio to the demands potentially from holders of those notes? That's a question. Does it mean that stablecoins are banks? Definitely not. I think there's certainly certain constructs, regulatory vehicles you could try and put together that reflect the reality of stablecoins. My thoughts on this generally echoes those of George Selgin, who's looked for a light touch approach, despite not being a crypto bull by any means. But yeah, I mean, the stablecoins are regulated, just perhaps not in the way that Paxos might want.
Yeah, I think that's a great point. Certainly, Circle and Coinbase historically as well have operated under these state-by-state MTLs, and so to say that they're unregulated just wouldn't actually be true.
Yeah, and one thing I'll say is, like, now we're getting into this contest where people try and show how liquid and near cash their cash equivalents are that are backing their stable coins. So Paxos, quite impressively, is 96 cash and cash equivalents, 4% treasury bills. USDC has a much broader asset portfolio. They've got some CDs, corporate bonds, muni bonds, some commercial paper. Tether, much more commercial paper. Like interesting asset portfolios. Maybe not 100% liquid, maybe not 100% short term. So you get three different schools of thought here, but I guess my point is there has to be a business model involved in issuing a stable coin. And if you're holding it 100% cash yields a negative rate right now. So there's no business model holding just cash. So, for a stablecoin issuance to be sustainable from a commercial perspective, there has to be some element of net interest income effectively. And Circle, they monetize their float at something like 11 bips. So it's not, an exorbitant amount of income they're making. So, I mean, I'm pretty sympathetic, frankly, to Circle's asset portfolio. I think if you go, maximally low risk and you just effectively custodying dollars, you're being sort of excessively prudent, frankly. I mean, it's unlikely that you're ever going to deal with 100% redemptions. That doesn't seem like it would be likely with the USDC, for instance. So I think you can have a bit of an asset portfolio.
Yeah, I agree. And it's certainly the market from a commercial perspective is speaking loud and clear in terms of what the preferred product experience actually is. And so you don't see a ton of adoption with the Paxos stablecoin. You don't see a ton of adoption with the Gemini stablecoin. So you're really seeing that surge on the USDC side.
So Bank of New York Mellon joined a consortium of 6 banks backing a new crypto trading platform called Pure Digital. What do you make of this?
Well, it's nice to see some more of these banks coming into the cryptocurrency side of this market. A few years ago, you would have seen a lot of consortiums, but it would have been a lot of enterprise blockchain consortiums. So it's good to see some positive developments here. banks holding spot continues to be just something that they're largely afraid to do, and don't believe that they have regulatory clarity in certain fronts under the Bank Holding Act to hold spot. So there's a lot of R&D work going on. There's a lot of people on the inside of these big banks that are trying to figure this out, and I'm sure they will. This is largely in the lab at this point, but eventually these will be big businesses.
Also in bank news, JP Morgan finally allowed their clients to buy GBDC on the platform, I believe.
Yeah, it was in a manner where you'd have to ask for it, so they can't be kind of actively pushing it onto their clients. But that is a good development. Harkens back to when Jamie Dimon said that if anyone at the firm was involved in cryptocurrency, he would fire them. So a lot of people would have been fired if they did this a few years ago.
How the turntables.
Tides have turned. Is that how the turntables?
How the turntables. Yeah, that was deliberate. Robinhood is paying a $30 million fine after New York State investigation into its financial compliance and cybersecurity practices. Does this have to do with their crypto trading unit?
Yeah, there wasn't a ton of detail on this, but the headline did say their crypto business unit. So looks like Robinhood settled a bunch of stuff, kind of on the eve of the S1 filing here. So file this one under that category.
That's a material fine.
Yeah. Next one up is we have a private equity deal here. So Advent International, which is one of the largest private equity firms in the world, actually based in Boston, has teamed up with the Stellar Development Foundation, it looks like. Stellar Development Foundation is, of course, the nonprofit behind the Stellar Protocol. So there's a report this week that the two are in talks to acquire MoneyGram, which is the large money transmitter remittance company that we all know took money from Ripple. So this is pretty fascinating. It looks like MoneyGram is on the block, and Advent and Stellar have a bid here.
Well, MoneyGram has been teetering on the edge of bankruptcy for some time, and Ripple buying their equity at an enormous premium and providing them these payments, effectively allowing Ripple to use MoneyGram and PR, kind of kept them on life support for a while, but I believe that has now ceased, given the SEC investigation. And now it looks like Stellar has kind of decided to use the MoneyGram asset for PR purposes.
Well, Stellar has a war chest over there. With that development foundation is very large, and so they have the ability to do big deals. This would certainly be a big deal, and MoneyGram has distribution. So, maybe the strategy here is let's buy some distribution and let's start throwing Stellar through those pipes.
I think I'm ready to move on from the payments tokens of yesteryear. Obviously, their hypotheses were not borne out. The only payment style asset that really succeeded on public blockchains was stablecoins. And the success of stablecoins just, I think illustrates the hollowness of this theory that people would use volatile assets as a bridge currency. It just didn't happen, and we have to acknowledge that at a certain point. When do you we have $120 billion of stable coins out there. No one's using Stellar or Ripple as bridge currencies for remittances, not in meaningful size.
I once told someone that I did not believe that Ripple would be an effective bridge currency, and they got really upset at me, and they asked me, well, what do you think would be better, like donuts or something? And I was like, no, fiat currency maybe. Where did the donuts? It's just such a ridiculous thing to say to someone.
I love donuts.
Yeah, they're not I don't think they're good either. It's probably they're just as bad. They're just as good as Ripple, but they're pretty bad at being a bridge currency.
Yeah, there was a good 3 or 4 years there when people really kind of believed the hype about Ripple being a bridge currency, and sorry to say, didn't turn out to be that way.
Did not happen. Well, we have another Bitcoin ETF filing. This one is from Global X. They're a large asset manager, and they are the newest one on the scene. So we'll see if we get a Bitcoin ETF.
I've lost count of them. What's their sentiment on the Bitcoin ETF. I feel like it fluctuates from week to week. This week, I'm pretty down on the sun. I would say it ticked down a notch on my internal barometer.
Yeah, no, it went down. Sentiment is down in the Walsh household as well. I think that, the SEC is probably just going through CoinGecko and trying to figure out what's a security right now. Probably don't have time for this Bitcoin ETF thing. It's just a lot of DeFi tokens to take a look at.
I mean, there I was feeling good about, a panel of Kathy, Elon, and Jack Dorsey, proclaiming their love for Bitcoin. So I was sort of happy about that. But the rest of the regulatory omens are definitely not good.
Yeah, there needs to be another run on the FUD dice.
Yeah, maybe we could do V5. I don't know. I mean, is there still appetite for FUD dice? Are there new FUDs?
For those of you who don't know what we're talking about, you can go to onthebrink.shop and you can check out the FUD dice. We won't explain the whole story, but you roll the dice and you get some FUD.
Yeah, it was, it's a physical meme, basically. The Wall Street Journal had an article on yield farming, entitled "Crypto Yield Farming's Chase High Returns but Risk Losing It All." Had a pretty nice animated graphic.
I thought this was a really good article. The fact that yield farming was being covered in the Wall Street Journal was surprising to me. I thought this was a pretty good piece.
They took a shot at Mark Cuban for farming and getting rug pulled on his farm.
Yeah.
Which, if you publicly admit to farming like total, farming on low integrity farmland, and getting the rug pulled out from under you, then you're probably going to get it. If you're a billionaire, you might get written up in the WSJ.
Yeah, I don't think Mark Cuban's that worried about it. I think he's just fine.
He called for regulation afterwards, so it seemed like his feelings were hurt. But yeah, yield farming in the WSJ. Who'd have thunk it?
Well, we have yield farming in the WSJ, and then we have central bank digital currencies in the New York Times. So there's an op-ed, and they basically advocated that the US should do a CBDC. They highlighted the fact that you'd be able to have frictionless interest rate policy. You'd be able to surveil for illicit transactions. So a lot of people would say those are reasons not to have a CBDC, actually. But New York Times wants one.
Yeah, I wasn't happy about this article. I mean, I think it was useful in the sense that it's kind of like in a James Bond movie where the villain monologues for 10 minutes, tells you what their plan is. That's kind of like what this article is. They're telling us what they intend to do with the CBDC, and it's not pretty.
You're going to send you money with an expiration date.
Yeah, I mean, and I tweeted this, but, this wasn't at my university, but a bunch of my friends went to school in Maryland, University of Maryland, and the system there was that your cafeteria account, your balance would be liquidated to zero at the end of the quarter.
That's how it worked. That's how it worked at my school.
So you went through this, and the effect on that is it doesn't have a good effect on society. It causes like carnage as you reach the end of the quarter or whatever it is. I mean, gluttony, and it's not a good model. It doesn't lead to sort of like proportionate consumption. So this notion of adding demurrage into cash and turning dollars into something more akin to like EBT, like food stamps, where they're conditional and what you can spend them on, it's just anti-human. And adding giving central bankers the tools to really granularly impose their experiments on us, like with negative interest rates on cash, is also horrifying. We should be giving them less power, not more. So this whole thing, is deeply concerning to me.
I don't know. I used to just stockpile Gatorades. I thought it was fine.
But I mean, the system would have an exit valve, because the problem is like there's like capital controls in the cafeteria because you can't buy store value assets, so you can't buy gold, or you can't offshore your wealth from the canteen situation. So you have to convert it into something that's like moderately store value.
Yeah, that was Gatorade.
So I guess that was Gatorade. For you, it was good as gold.
Yeah, stockpile that Gatorade. But yeah, it's a good point. We're going to get these central bank digital currencies. They're going to be cash with expiration dates. There's going to be negative interest rates exerted on people. It's going to be, we're going to see how this goes.
Yeah, I'm not happy about it. And one thing Elon kept talking about in his talk was all of their reserves held in Europe were just getting nailed by negative interest rates. So people are waking up. They don't like negative interest rates. Let me tell you.
All right, so I think that's it for the week. We'll have an episode on Monday. We haven't had as many interview podcasts, but you'll have one on Monday.
Yeah, sorry, we've been remiss low these last few weeks, but we do have an episode. It's with Michelle Rocks, who is at the Cambridge Center for Alternative Finance. We're talking about their new data release. If you're a Bitcoin energy wonk, you're gonna love it. If you're not, you'd probably be a little mystified by it. But it's a very important episode.
Well, we will see you on Monday. Everyone have a great weekend.